In this video, I will do the technical analysis of S&P 500 index for the week commencing from February 14, 2022. This technical analysis, it will be in two parts. First, I will do it on the weekly chart and then I will do it on the daily chart. So this way we will be able to get the most accurate results as we are getting for last many months. Now, before I do the technical analysis, let me show you how the market reacted to the previous technical analysis. Okay, so last week, see, this is the technical analysis of the previous week. So previous week, I told you that this is the zone in S&P 500 index 4,575 and 4,527. So I told you that if market manages to close above 4,575 on two consecutive days, see, 2. I told you that 2 consecutive days, in that case, it will move up towards 4690 and 4740. But if it failed to close above 4575 on 2 consecutive days, then it will come down. Now if you see, this was one candle that was able to here it was February 9th. S&P 500, it was able to close above 4575 on February 9th, but the other day it came down. Okay, and because the other day it came down, so we can see the result here. Okay, this is the result on February 11th. So it further came down. Okay, so I told you that there must be 2 consecutive closing, means 2 closings, these the 2 candles must close above 4575, then only it will move up, else it will come down. So this is what happened, okay, in the previous week. Anyways, now let's move on to our technical analysis. So we will first do the technical analysis on the weekly chart. Okay guys, so we are here on the weekly chart. This is the weekly chart. Okay, weekly chart means one candle represents 1 week, not 1 day, 1 hour. One candle means 1 week. Okay, so now if you see here, first the interpretation of the candle. If you see, the market was coming down, and then there was a rebound, further rebound. But this particular candle, okay, this particular bull candle, this candle, it failed to close above the moving averages. So you can clearly see the closing is here below the moving averages. Okay, so it was bearish, but it was expected that if for some reason, if on the weekly chart, if there is a closing of the candle above these moving averages on the weekly chart, in that case it will be bullish, else it will not. Okay, so now in the recent week, in the recent week, you can clearly see that S&P 500, okay, it has closed below all of these 3 moving averages. Okay, and it came down, which means that it is further supporting the bear trend. Now let's do the technical analysis. First we have the Bollinger Band. This is the lower band of the Bollinger Band. This is the median of the Bollinger Band, which means the market is bearish. Then comes the moving averages. These are the moving averages on 2 consecutive days. So not 2, 1, 2, 3, 4. Okay. So these 4 candles have closed below this the moving average. Okay, not just one, but all of these 3 moving averages, which means the market is bearish. Then comes the Ichimoku. Market has closed above the Ichimoku, which means the market is bullish through Ichimoku on the weekly chart. Now if we look into some other technical indicators, so the other technical indicators, we have MACD, okay, moving average convergence divergence. So MACD, directional MACD is clearly bearish. Okay, but if you see this, the divergence in the price of the index corresponding to the moving average, okay, so that divergence is increasing. So this increase in divergence, okay, it may work against bears, because see, whatever happens, whatever be the case, the divergence must not be too high or too heavy, okay, especially in MACD. So in order to cover divergence, okay, market may take a rebound, okay, may form a bullish candle in order to cover this divergence means not all of it but some of it. Okay, but directional MACD is bearish. Then comes the stock RSI. Okay, stock RSI market was trying to move up, but see, it is still the K channel is 10 and the D is 7, which means it is still bearish. Okay, but it was trying to move up. Okay, then comes the divergence. So divergence in the prices of the candles, this is normal. Then comes the momentum. So momentum is good, almost 50 in favor of bears. So through all of the technical indicators except the Ichimoku, okay, it is confirmed that market is bearish on the weekly chart. So market is clearly bearish on the weekly chart except the Ichimoku, and also this the fan out of this the moving average. Okay. So now let's move on to the daily chart to see how the market is going to behave, okay, on the daily basis. Okay guys, so we are here on the daily chart. This is the daily chart. Okay, so daily chart means one candle represents one day, not 1 week or 1 hour. One candle means one day. Okay, so now let me write down the support and resistances here on the daily chart, all of this, and then we will do the technical analysis. So these are the support and resistances. Now let's first do the technical analysis. Okay, this is the lower band of the Bollinger Band. This is the median of the Bollinger Band. Market has closed between the lower band and the median, which means the market is bearish. Moving averages, market has closed below the moving averages, and there is a clear fan out that is supporting the bears, which means that moving averages are clearly 100% supporting the bears. Then comes the Ichimoku, because market has closed below Ichimoku, which means the market is bearish. Then some other technical indicators. Okay, so we have MACD. Now MACD is bullish. As of now it is bullish, but it is trading in the bearish territory. See, so the directional MACD, it is bullish but trading in the bearish territory. Then comes the stock RSI. Stock RSI, if you see, the K channel is 78 and the D channel is 83. Okay, which means that it is bearish, but still it is trading above 50. Then comes the divergence. So divergence is normal, not a problem. Then comes the momentum. Momentum is 20, almost 20, 21. Okay, so it is neither supporting bulls nor supporting bears. This means, so through all of the technical indicators, okay, this thing is confirmed that there is a bear trend in the market and there are bear sentiments in the market. This also means this particular candle and this particular candle, this particular junction, okay, it is acting as a lower high. Means market came down, bounced back, okay, there was some hold here, and now it is coming down, which means that it has formed a lower high, which means that market is expected to remain bearish. Okay, now let's deduce the momentum, or the movement of the market. So movement of market, see, as of now it looks very clear that because market has failed to close above 4575 on 2 consecutive days, okay, it is bearish. And secondly, it has closed below all of the moving averages, so it is bearish. Okay guys, so there we have our 200-day moving average. See, on January 28th, okay, because on January 28th market closed above 200-day moving average, and that was the reason why market went up. And this is exactly, I told you that because of this the market will shoot up, and market did. Okay, so 200-day moving average saved the market for once. Now again you can see that it, so there was see the market, okay, it came, it crossed this the 200-day moving average, then it retraced a bit, but it manages to close above the 200-day moving average. See, this thing, okay, it did not happen in this case. If you see this particular bear candle, it closed below 200-day moving average, okay, and that was the reason why it further came down on Monday. Okay, but in this case, in this particular case, if you see, it has just closed above 200-day moving average, which means that yes, still there are chances market is going to rebound. Because of this, the 200-day moving average, okay, so it got support at 200-day moving average. Now there are some conditions for the rebound. Otherwise it is going to come down. That is so this thing is very, very clear. See, on Monday, so you need to wait for Monday to see what happens on Monday particularly. So if you see that there is a candle, okay, and sorry, this 200-day moving average, it will remain here, okay, it is not going anywhere. So it will be around here, around 4,410 or 4,405 or so. If you see that market has closed below 200-day moving average on Monday, okay, in that case market will certainly come down, will hit the Ichimoku, okay, will hit this particular support 4290, okay, and then like I told you that if it is able to bounce back from 4290, then it's good. But if it manages to cross and close below 4290, in that case nobody is going to save the market. Okay, now so this is one condition. The other condition is that if on Monday, if the market manages to close above above 200-day moving average, see, this is 200-day moving average, okay, so the whole picture will revolve around 200-day moving average in the coming week. So yes, so if the market, if it manages to close above 200-day moving average on Monday, which means there will be two candles, okay, two consecutive candles and two consecutive closings above 200-day moving average, in that case, yes, the market will retrace. Okay, so this is how the market is going to work next week. Okay, but again, see, we have these all of our support and resistances. And one more thing, market is not bullish until and unless it closes it closes above the Ichimoku. So first it has to come up, and then somehow it has to cross the Ichimoku to enter into the bullish side of the Ichimoku. Then only the market will be bullish. But until then, okay, when it is trading below Ichimoku, which means that there are no chances market is going to be bullish. Okay, but yes, it may form again and again lower highs. Okay, so guys, this is how the market is going to work or react in the next week. So guys, I have given the link to my Discord spreadsheet in the description of the video, so you can take a look, and whenever you are ready to join the group, so you are welcome. So just drop me an email. Okay, so guys, this was my technical analysis for S&P 500 index for the week commencing from February 14th 2022.